Okay, trade recap for today, which is Tuesday, May 21st. So, if we go back and look, first and foremost, this was kind of a pretty unique day, and that's another reason I wanted to kind of do a trade recap video slash kind of like an in Discord type of thing, trade recap, because we retraced midnight open pretty much on the dot. Actually, if you go to the 1 minute time frame, we retraced midnight open on the 8 o'clock candle. And for those of you that don't know, I trade the retracement of the midnight open between the hours of 8 o'clock to 11:15 a.m. EST, because that is objectively the highest probability that we have. Between the hours of 8 to 11:15 a.m. EST, that is when we are most likely to retrace. Why do we know that? Not based off of feelings, not based off of emotions, but the data that we have right here. So if we know with a very high probable opportunity that this midnight retracement is going to happen within this time period, then that's the direction that I'm initially going to be taking and looking for when it comes to trading. When it comes to trading the NASDAQ, right? Now, when these midnight retracements happen, literally on that candle, it's no good anymore, because I get this common question a lot of people that say, okay, well, it retraced, now what? Well, now midnight retracements is done. Because a lot of people, they constantly think that, okay, this was played out, now can I do it again? Well, you could, but you don't have data to see, like, out of how many times it retraces, how many more times is it going to do it? Like, it's just, the edge is now diminished. So another thing that we do within the Pack Trade group, and now this is very specific to the indicators that we do have, but again, you can use liquidity, you can use structure. There's many different ways that you can go about it, but I have a very specific edge, and that's what I'm going to talk about. So my edge on top of trading midnight retracements is these little green and red wolves. And now what these are is, this is my proprietary, I guess, code, you could say, on how I measure the leptokurtic distributions of price. And that's a very fancy word for those of you that are new, is everything in the entire world has a distribution, okay, a leptokurtic distribution. A lot of what we do is right here, before the move happens, this is where we as traders want to be. We want to be before that distribution is made. Okay, so what this is allowing you to see is, based on statistics and math, the high probability distribution areas. Okay, this is not a blind buy and sell signal. This is the last confluence I need in a specific data-driven area. I'm not just going through and buying and selling when I see a red or green wolf. That is 1000% not what this is. But this is, once I have all the other data sets collected between the hours of whatever time I choose, that is then the last confluence I need for a specific type of trade. And this is what we're going over today, which is distributions. Now today, Tuesdays are usually, keyword usually, higher distribution days. If you take a look at my chart here, let's go to the 12-minute time frame. Why do I go to the 12-minute time frame? Just because this gives me about 170 to 180 days of data. I don't want years of data when it comes to average distributions of the AM and PM session. Why? Because the distribution that was made 2 years ago does not matter in today's market climate. Market conditions change constantly. And with those market conditions changing constantly, I don't want to be trading the way NASDAQ moved 2 years ago. So that's a cool thing with this indicator that we've made here, is that I'm able to see current market conditions. And so on Tuesday, the average distribution is 105%. Let's go look at last Tuesday's, and you can see almost to a T, look at where we distributed. Look at where price went to almost on a dime, 1.05% right here. Let me fine tune it. And then we started correcting until the PM session. And in the PM session, look at the PM, 0.73%. 0.73%. I mean, last Tuesday was a perfect statistical day. And why are Tuesdays, majority of the time, not all the time, statistics are about probability, not prediction. Why are Tuesdays the higher, I guess, distributed days of the week? That's because in most of the weeks, that is when the high or the low is going to be set for the week. Okay, either Monday or Tuesday. If it is an objective bullish week, Monday or Tuesday is going to be the low of the week. Go back and look at this. I promise. Like, go back and look. 7 to 8 times out of 10, you're going to see the high or the low of the entire week statistically is made in a Monday or a Tuesday. And then vice versa. If it's bearish, the high will be made either Monday or Tuesday. And so today, you can, and that's why, like, by Wednesday, once you start to assess how Tuesday's price action was, if it either broke a new high or a new low, you can have a very, 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 very high probability of where the rest of the week is going to be. Now, does this help me with trading? I was telling my pack trade group this morning. Does this influence my entries? Does this tell me exactly what I'm supposed to be doing? No. Like, all it does is it allows me to see where the markets are most likely shifting to. And so that way my areas of context, aka footprints, becomes that much more valuable. So look at where price is today. Right now, we're in pretty much unique territory where we're in all-time highs. So all-time high territory, it's kind of unique price action in terms of, like, we're just making all-time highs, right? At some point, we're going to sell off from all-time highs. That's just what happens. Institutions, hedge funds, people that move the market, they're going to take profit at some point. And that's going to move the market down. Like, it's just objectively what happens. So look at, even though we are in all-time higher territory, look how powerful statistics are. The low was made right here, Monday, 9/24. And so if we continue to create structure in all-time highs, then this is just another statistically in tune week. And so we take a look at today on Tuesday, and yes, we were below the average statistic of what Tuesday usually offers. Let's take a look at what PM delivered here. PM was also low, 0.73. You'd be like, well, Austin, well, today was an out of statistic day. How would you trade it? Great question, right? Because I don't just trade the extremes of either side of the statistic. I also trade as the statistic is being formed, aka my distribution trades. So if we go down here to the 1 minute time frame, you can see first trade that we took was, and these were all 10-point trades. First short was here. And then I don't know why there was not a gap here this morning. I don't know why the heck there's a random gap. So we got 10 points, and then the next high probability setup was another short right here for 10 points. Now, after I increased risk off of these two trades, I dramatically decreased risk. I got another nice long opportunity here where we have bullish distribution to the upside, 10 points. And guys, this is boring. Like, this is boring and unsexy. I'm going to keep repeating the same thing. 10 points, 10 points, 10 points. And some of you coming from other ways of trading and other styles of trading, you may be like, dude, what the heck? Like 10 points? Bro, if you don't trade with a 70 risk to reward, are you even really a trader? Like, if you don't get these sniper entries, ladies and gentlemen, hedge funds, institutional trading companies, all these people, do you think they're sitting here trying to find the best entries? Do you think they're sitting here trying to trade 70R trades? Absolutely not. They are happy with base hits. You know why? Because base hits turn into home runs, but in retail, home runs is what everyone shoots for, right? And those home runs turn into liquidity for the base hits of major players. So I'm not going to reinvent the wheel, right? I'm not going to reinvent the wheel and try to make something more than what I am. I am not here to be the Michael Jordan of trading. I'm not here to be some expert master trader. I'm here to get my small piece of the pie and then show up the next day. And so these base hits turn into home runs, right? We got 10, 20, 30, and some people in the pack trade group even kept on going. I got 30 points today, right? Whether you get that in one trade or 3 trades, that's still 30 points. And these two, I traded the NASDAQ mini, and then this one was a micro MNQ trade. So they add up. And the biggest thing that I want you guys to see here is with this distribution, take a look at the hourly. Even if you don't have this indicator, take a look at what we did liquidity-wise. We have this giant footprint right here. Oh, We have another footprint right here. Look at where we came into to absorb that buy pressure, and look at what happened. We never even broke. We wicked out of it, but even on the hourly, we never broke this footprint. We came in here, took buy pressure, and again, this is objective buy pressure. Everyone has the same wicks. This is why I love the way I trade. There is no subjectivity here. Everyone can pull up on the hourly time frame on MNQ, and everyone has that same wick at 1400. It does not change. And that wick right there tells us people that are able to move the market created that. I don't care about a random fair value gap at a certain time, at a certain time frame, on a certain way of how the fair value gap forms. I don't care about a certain order block. And again, I'm not downing these models. I'm using them as examples to show you all that it's very subjective. And I want to eliminate as much subjectivity from the way I trade as much as possible. And the only way to do that is use what everyone else has on their charts. And what everyone else has on their charts is everyone can clearly as day see this wick here, and everyone can clearly as day see this wick here. This gives us context to know where price is most likely going to be attracted to. If we see this hourly candle close below this footprint, then common sense tells us the next pit stop for price is here. It could break it or it could rebound, and that could be the catalyst for prices to continue higher. But I don't care what happens 5 days from now. I care about, because I'm a day trader, the hourly. What's happening within the hourly? What's happening now? Because I'm a day trader. I don't care about what's happening next week. And so when you add statistics, okay, when you have data to tell us, okay, we already retraced this midnight, now we're going to shoot for distributions. Okay, boom, we still have not hit the max distribution. I'm taking either side of the market because, again, I am a day trader. And then if I'm done for the day, I'm done for the day, right? I was done for the day before the market even opened. We were done in the pack trade group at like 9:24, I think it was. Like the market wasn't even open and we were just hanging out and talking. Now, I do want you guys to take a look at oil, because oil was a perfect in statistic day here. Now, again, I don't know why my indicators are just like, my trading view is just not even working. Like, look at this. I can turn it on and it's not even, it's just not even turning on. So let me try adding this to the entire layout again. Add this indicator to the entire layout. There we go. All right. Let's turn this table off because you don't need to see this right now. Table. All right. So you can see here, if we go look at the distribution for oil, because some people here trade oil, but even if you don't trade oil, this still applies to you because you can see how this works. So with oil, today's Tuesday, look at the distribution on oil. The previous 10 Tuesdays measured, we have had a 1.05% distribution from the hours of 6:30 to 9:30, because that's all I'm trading oil on. And so from the hours of 6:30 to 9:30, we have that average distribution of 1.05%. So as price was coming down here, let's go into replay mode, and you can take a look at this live. So as price was coming down, we took a nice base hit here for 10 ticks on oil. Because again, why am I doing that? Because you guys can even see, if I turn the table back on, this is my average distribution in favor of oil for any given one of these, because this is what this is showing you, is the average. This is why like data is so amazing, ladies and gentlemen. My entry aid, which gives us objective leptokurtic distributions of price on the 3-minute time frame, can get an on average 0.16% price movement in its favor for longs, and then 0.15 for shorts. So let's just, for simplicity, say 1.15. Let's take the lowest. 0.15% on the chart is 12 ticks. So if I know that the average is here, I want to shoot below the average to get a even more common. Like if this is common, I want to shoot for the even more common. Okay, so that's where I get my 10 ticks from. So from 6:30 to 9:30, I know that objectively speaking, because the data tells me that I can most likely get at least 10 ticks from my distributions from either side of the market until we hit a max. And so here is a perfect example of we come down and we hit the bottom side of the distribution for the day. Look at that. On a to the tick almost. To the freaking tick. No fair value gaps, no multi-time frame analysis, no RSI overbought flippity flip and doodah day. None of that. No other analysis did I use other than to understand what has price done the previous, in this case, nine Tuesdays. In the previous 9 Tuesdays, how far has price moved? How far has price moved? That's all I need. I don't need to know anything else because data is one of the most objective ways to look at the markets, ladies and gentlemen. I'm not saying this is the best way of trading. I'm saying with a definitive doubt of data is the most objective way to look at the markets because data can only be data with data, right? Like if you get up in the morning, and I like to use this analogy. OJ, you're not muted, bro. I like to use this analogy. If you get up in the morning and go and brush your teeth. Okay, I'm gonna mute you, OJ. If you get up in the morning and brush your teeth, and then the next day you get up in the morning and brush your teeth again, you just created data. You have just created statistical probabilities that in a certain time period, from the moment you wake up, there is an average distribution of when you brush your teeth. Okay, so if you go and look in the chart, if you're just looking at my chart here, let's use this distribution curve, and you wake up at least 5 minutes from when you wake up, you go and brush your teeth. But let's say one day you run late. Okay, well, this was 2 minutes. And then, so 2 minutes is over here in the earlier part. And then maybe you're taking your time because you woke up earlier than expected. Okay, so you're over here at 10 minutes. And then right here is your 5 minute window where you on average brush your teeth for 5 minutes. So you create, everything is created off of statistics. Everything we do in the world. And so if human beings naturally create statistics, naturally create data, because that's just how the world works inside and outside of trading, and if human beings created the market, even if it's driven on some magical algo, because everybody thinks it's just off of one master algo, let's just assume it is. Let's assume the entire world of the market is just off of an algorithm. Who created the algorithm? Human beings. And so even in that algorithm, it's going to have predisposed human instincts inside of it. It's going to have human behaviors inbuilt into it because it is created by humans. Like even if you look at coding in the car, in the vehicle industry, right? If we build 1,000 cars, and all 1,000 cars have electronics in them and they all do different things, do you think all 1,000 vehicles are going to operate the same exact way, even if they have codes in the electrical circuit boards to operate the AC, the radio, the ignition? No. There's going to be flaws. There's going to be ones that break a little bit quicker. There's going to be ones that can just naturally have withstand to the environment that car is in. Like, you're still going to have a distribution curve. No matter how perfect we as human beings try to make something, you're still going to have a distribution curve of the majority and the minority. So in trading, that's all it is where can I get in at the most high probable statistical area, and then where can I exit? And then how can I use my risk management to capitalize on that high probable area? And see, this is another thing that so many people come into the trading industry and they have this brainwashed, skewed mindset of what trading is. And they see one video that somebody got a sniper entry right here with a stop loss of 5 centimeters, and they got an 11R trade, and they think that this is the only way to trade. They think the only way of trading is a high win rate, high R, or a low win rate, high R, low R, high win rate. Like, they're so focused on just those two statistics, those two data points, that They're blinded by a sea of data points. Ladies and gentlemen, win rates and risk to rewards are only two factors in a sea of factors. That's like if you are a car enthusiast and you only focus on the wheels, or you only focus on the horsepower, or you only focus on the windshield. Like, if you only focused on just two of the many components of a car, you don't have a car. And so in trading, all I'm doing is I'm focusing on the holistic vehicle. I'm looking at the vehicle as a whole. And then I'm capitalizing on the flaws that that vehicle has and when that's most likely going to happen. So in this oil, in oil today, we have an objective 1.05% distribution. And look at where, again, like this, to a T where we paused. And then now this tells me I only am looking for longs. That's it. I'm not looking for shorts anymore. Why? Because if I know, let's just imagine this box is the average distribution of an asset for a specific given day. And let's use this as an example for right here. If I know that an asset is going to move on average this much in a given session, right? And then now it moves. Why would I be looking for shorts here? If we have statistically moved this much in a certain time period of price, why would I want to take shorts? That's risky. And again, I want to preface this. We're not predicting. Could this keep on going lower? Absolutely. Absolutely it could. But I'm a trader. I go off probabilities. I go off this thing right here. This little word right here, probability. You don't see that say price retrace guarantee, price retraced forecast, probability. So if I'm a trader and I go off probability, then this is an area that does not give me high probability to continue going short if price already moved X amount per session. And so I would only be looking for longs to capture the mean reversion or the revertant of the average price. I only want to capture the reversal of this. And guess what? Here's the beauty of what I'm doing. I'm not trying to get, again, a 20R trade that magically just, looks so sexy. I'm not looking for that. I'm looking for small, bite-sized pieces of what my way of trading and viewing the markets can provide based on data. Based on data. That's it. So if my data tells me that on average my distributions can provide me 0.16%, then I'm going to go a little bit lower than that. So that way I know that I have an even higher probability of getting my target hit. Does these lose? Absolutely. I still take losses and everyone does. But this gives me the best edge that I personally can have against what I'm doing. And so now take a look at what price did. We hit the bottom side of the max distribution. We had a long setup right here. So obviously that fits within my criteria to take right there. 10 ticks. And 10 ticks, and we were done for the day. On oil, we captured 40 ticks. 40 freaking ticks on oil, which if you don't know, that's a pretty decent paycheck payday. It's a pretty decent day. And so, again, this is not to gloat. This is not to brag. I'm just letting you know this is what we do every day. Now, do we win every day? No, I'm not saying that. But we are able to view the market in the most clearest lens that I personally know how every single day with no stress. I'm not sitting here stressed out, wondering where price is. And why is this? Why is it that I can go into trading and not be stressed out being in drawdown, not stressed out about taking a losing trade, whatever, because I know that this data is going to be repeated every single day until the market shuts down or becomes this evil thing that only the superior elites will ever be able to trade. I know that I have a skill that I can capitalize on until the day I die, right? I know with an objective fact that this is going to provide me data every single day. And it's current data. It's not like this is some, indicator-driven algo that only works in a trending market or a consolidating market or anything like that, right? Because this moves with the market. This data is created with the market. And so do you guys have any questions at all in the chat? I see Anya Anya asked, my question is, with today's example during the New York Open, price that touched the midnight open, in that scenario, you avoid taking the trade. Oh, okay, yeah. I think I already answered that question, Anya. But just to reiterate for those that are new or want to listen to it again, yeah. So this is kind of like my unique edge that I have is we retraced midnight open already. And so now all I care about is the distribution of the average price movement of this session. So if you're not a pack trader, I mean, you don't have this, but again, I'm not going to bullcrap you guys. Like, I'm not going to create some way of capitalizing on this movement that I don't personally use. I'm just showing you guys what I use, which is, again, distributions, which is these bearish wolves and bullish wolves. And so I was able to capitalize on some nice price movements of this. And you'd be like, well, okay, well, Austin, what if this trade goes against you? I scale into my positions. So these were all base hits, but any one of these could have went into drawdown. Like, let's say this short right here. Let's say this short went into drawdown. I would scale into this position. I'm not martingaling. I'm not adding to a losing trade for infinity. I am using data to tell me when I should add into my position if this is in my favor, and I'm still collecting those 10 points. So let's say I get another bearish distribution up here. Well, if I only do one contract here, I'm not going in 10 contracts deep, 20 contracts deep or anything crazy. It's just a slight little scale in. If I get another one, say here, then the beauty of dollar cost averaging into a position, now my average entry is here. And so now this 10 points is not only worth more, price doesn't have to move as much to get to that 10-point level because it's already been here. It doesn't have to make a new movement for the day. It just has to come back to here. Right? And that, again, that's not martingale. I want to make that perfectly clear because so many people they hear dollar cost averaging, and again, they people have this brainwashed, skewed mindset that the only way to make money in day trading is single entry, high R trading. That's not. There's hundreds of ways to make money. That way makes money. This way makes money. There's so many ways. Martingaling, for those of you that don't know, because that's the common thing that I hear when it comes to dollar cost averaging, martingaling is if I lost a position. They're single entries. Okay, it's a very terrible way of trading. It's if I lost this trade, let's say this is my stop loss. I don't know. I'm just let's say this is my entry. Okay, boom, stop loss hit. Let's say I did one contract. So now I would do two contracts. Like this trade's over with. I'm not still in this trade. Now I would do two contracts. Okay, boom. I got stopped out. Now I do four contracts. Okay, boom, I'd get stopped out. Okay, now I'm going to do 8 contracts. And I'm just doubling and doubling and doubling and doubling for absolutely no reason. All losing trades. Like, these are realized losses. This is an unrealized loss that I'm talking about here. And I'm using data to tell me when to scale into my position and engage with the price. Down here, this is just gambling. This is just legit gambling. That's it. So I want to make sure people understand that because that is one common thing I hear. What's up, Erebos? Greetings, everyone. Alex, bro, these statistics are freaking dude. I mean, that's why I shout this from the rooftops, man. Because trading with a statistical edge is just so it's fun. It's fun because you have the most simplistic way of looking at the charts. You don't have a bajillion different markings and rectangles and indicators and all this stuff. Like, dude, my chart is pretty clean versus some craziness that I've seen on social media. And compare that to also just having an ability to read price regardless of the way the market's moving, regardless of if we're in a bull market or a bear market, regardless if we're consolidating, regardless if we have news or no news, regardless of what day of the week it is, we have such a high probability of every single day understanding the market, how it moves, and when to engage. So I hope this trade recap was useful for you guys. For those of you in the live chat, if you could just let me know, especially for the free members, if you could just let me know this was helpful for you. Even if you're in the pack trade group, though, let me know if this was helpful. I'll try to do these about 2 to 4 days a week, just when I can. and then I'm going to upload them to my YouTube channel for the people that can't make the live sessions. And yeah, have a wonderful day. Leave me any feedback that you want. And yeah, that's it. Bye, guys.